Good Monday, this is Jay Brew, co-chairman of Seafried and Brew. As we're crossing the May mark of 2012, how do things look so far this year? Are you on budget? Are you over budget? And where do you think things are going as you move into year end? At least so far, we really haven't heard that much of actual margin compression, even though the expectation is that as we get further into 2012, that most likely we'll be seeing that. So we look at two different things, and especially in the area of non-interest income. Looking at non-interest income in here, what do you think is going to happen to your overall levels of non-interest income? How can you offset that in terms of increasing that? A week or so ago, we talked about looking at BOLI again. And if you hadn't done it, is to look at doing BOLI as an asset. That, of course, goes into non-interest income, as well as that if you do have BOLI, that I would suggest away from credit concerns, maximizing your BOLI to the full 25% of capital. So when we think about it, another piece is the offering investments in here. Is that many banks have had various experience with looking at adding an investment component to non-interest income in terms of offering investment products. Some have had good experience. Others have had lesser experience in this particular area. Well, the way to do it in all of these areas of net overhead on the non-interest income side and the non-interest expense side is to go out and go to the banks that have the highest level of non-interest income in the country and ask them how they do it. How do they get up to those levels? Is it a combination of these type of situations that move them up into that higher level? How are they doing it differently than you and making more money in that area? Because going back to offering investment products, not all programs are the same. Not all programs are as profitable. Who is giving the most profitable programs out there is to go and ask other bankers. That maybe if you don't offer investment type products, that maybe now is a good time to start doing it. One of the things that I look at is that does the investment products bring in new accounts to you? Does it increase your overall level of cash type deposits? A lot of bankers are scared that that money leaves the bank, when in actuality an excellent program actually brings in more customers to the bank. And it gives your customers more of a choice of where to put their money, especially at times like this. So don't let that money go out to big brokerage houses. Let that money also work for your bank in the form of non-interest income. So as we think about this, is that how do we think better? Also on the net overhead side, the non-interest expense piece. And we've talked about that before in terms of, once again, going out and looking at the banks that are the most efficient in the country and saying, how can we garner those levels of efficiency? Because as we move into a continuation of this low rate cycle in here, and we start seeing margin compression because we can't drop our costs anymore, things like non-interest income, things like cutting non-interest expense, or more or less becoming more efficient, is going to become more of the catchword in community banking. This is Jay Brew. Have a good week. Co-chairman of Seafried and Brew.